Welcome to this explainer. Okay, so today we're looking at the last 6 months of financial market data, and I'm just going to tell you right off the bat, it has been an absolute masterclass in why human intuition is honestly terrible at managing money. Seriously, if you're looking at your current portfolio and you feel perfectly comfortable, happy, and euphoric about it, the data we're about to unpack proves that you're probably doing something wrong. We're going to break down exactly why financial markets constantly punish the obvious and reward the uncomfortable. So let's just dive right in. The quote here translates to investing must be unpleasant. Think about that for a second. It sounds completely backwards, doesn't it? We usually think that if we just study hard enough, we can crack the code to the markets and eliminate all the stress. But the source material for today's explainer emphasizes that discomfort, it isn't a bug in the financial system, it's actually its deepest structural feature. This quote really needs to become your ultimate bullshit detector. The paradox is basically this. As long as your investments feel slightly unpleasant or even a bit boring, you're probably on the right track. It's exactly when investing becomes universally thrilling and perfectly comfortable that the absolute biggest risks are hiding right under your nose. Here is our roadmap for today. Number 1, the investment paradox. 2, stocks, bonds, and inflation. 3, the price-yield link. 4, complex diversification and gold. 5, the dollar as a safe haven. And finally, number 6, rules for effective decisions.
All right, kicking things off with Section 1, the investment paradox.
Moving right along to Section 2, stocks, bonds, and inflation. You know, financial markets have this really annoying habit of completely dismantling our consolidated certainties. Just when you think a narrative makes perfect sense, boom, the market flips the script. Over the last 6 months, the contrast between the real returns of stocks and bonds in our current inflationary environment has been absolutely staggering. Global stocks surged around 15%, and emerging markets jumped a massive 32%. But this wasn't some broad, rising tide lifts all boats victory. It was heavily concentrated. Markets in South Korea and Taiwan just exploded, driven almost entirely by the artificial intelligence boom. I mean, in Korea, just 2 hardware companies, Samsung and SK Hynix, make up 50% of the index. Meanwhile, bonds have been downright stagnant. Fears of inflation pushed short-term yields way higher, particularly in places like Germany that were facing energy shocks, leaving overall bond returns totally flat or even slightly down. So it's really the ultimate tale of 2 different worlds, euphoric tech concentration on one side and frustrating stagnation on the other. And hey, if you ever needed proof that the market consistently outsmarts the experts, just look at this number, -30%. In early spring, when geopolitical tensions really flared up with Iran, the consensus out there was pure panic. Stocks were dipping, long-term bonds were down, and the experts were all over television predicting that oil would just skyrocket to over $200 a barrel. It seemed like the perfect setup for a total disaster, right? So what actually happened? Well, stocks roared back to life, and the price of oil plummeted by nearly 30%. The collective intelligence of the market just consistently knows more than the smartest individual forecasters out there. Which brings us to Section 3, the price-yield link. Now, because of inflation, bond investors have honestly had a miserable few years. But to understand why that terrible past performance actually sets up a really positive future outlook, we have to talk about yield to maturity. For 15 years, bond yields basically did nothing but drop. And while that artificially inflated their current prices, it completely destroyed their future earning potential. But the recent inflation shock, it totally reversed this. Yes, it absolutely hurt the current price of bonds, but it recharged their yield to maturity. And historically speaking, there is literally nothing that predicts the future expected return of a bond index better than its current yield to maturity. See, unlike stocks, which are all over the place, relying on unpredictable corporate earnings and, the next big tech innovation, bonds are delightfully mechanical. It's basically a 3-step process. Step 1, inflation and interest rate fears rise. Step 2, the current prices of your bond ETFs fall to compensate. But step 3, and this is the crucial one, those future yields mechanically increase. A bond ETF that has spent the last decade returning a big fat zero is finally positioned to actually generate fixed income. So the very reason you might absolutely hate looking at bonds in your portfolio right now is exactly the mathematical reason you should want them for the future. Okay, let's shift gears a bit. Section 4, complex diversification and gold. If bonds are mechanically straightforward, complex diversifiers like precious metals are psychologically exhausting. Let's take a look at gold. Earlier this year, gold went on an absolute tear, surging toward $5,600. And man, it felt fantastic to hold. But why was it rising? Well, it wasn't acting as a defensive safe haven. It had actually become a fashionable momentum trade. Retail investors were just jumping on the bandwagon left and right. But the moment the macroeconomic reality shifted, when U.S. Treasury yields rose, offering a solid risk-free alternative, and when all that geopolitical panic kind of subsided, gold plummeted right back toward the $4,000 mark. It just goes to show that when a diversifier becomes the hottest trend in the market, it stops protecting your capital and just becomes another highly volatile, high-beta asset. The harsh reality here is that complex diversification is incredibly difficult to maintain. Think about it. Stocks have negative asymmetry. They spend most of their time growing and only occasionally crash, which makes them psychologically pretty easy to hold. Commodities, on the other hand, like the Bloomberg Commodity Index, which actually jumped 20% this year, they have positive asymmetry. They experience these violent, short spikes during crises, which is exactly when you need them to protect your capital. But they spend the rest of the time trapped in agonizing, multi-year declines. To get the benefit of that brief spike, you have to suffer through years of watching that asset drag your overall portfolio down. It takes serious discipline, let me tell you.
Now for Section 5, the dollar as a safe haven.
While gold and bonds were kind of failing to act as protectors during this year's geopolitical stress, the real hero was actually hiding in plain sight. 5%. That is the extra return that unhedged European investors practically got for free simply by holding assets denominated in US dollars. Going into the year, pretty much everyone expected the dollar to weaken after a solid decade of strength. But instead, it acted as a standalone asset class, mitigating moments of severe stress and adding a 5% buffer to portfolios when everything else seemed totally uncertain. Now, looking at the broader macro picture, the dollar spiked for three very specific temporary reasons. First off, the energy shock reestablished the dollar as the ultimate currency of last resort. Second, surging bond yields in the U.S. made the currency highly, highly attractive. And third, the Federal Reserve had to hit pause on its rate cuts because of sticky inflation. But, and this is a big but, a word of caution from the data. These are temporary factors. If the conflict in the Middle East stabilizes and the Fed resumes cutting rates, this whole cycle could very easily reverse.
And finally, wrapping things up with Section 6, rules for effective decisions.
So we've seen euphoric AI stocks, we've seen mechanically sound but currently painful bonds, fashionable gold, agonizing commodities, and the surprise strength of the US dollar. What does this all mean for you and your money? Well, if you want a portfolio that actually survives crises and you want to make truly effective financial decisions, there are some hard truths you have to accept. You have to accept that true diversifiers will spend most of their time underperforming. You have to acknowledge that the market will always outsmart individual apocalyptic predictions. You must treat boredom and frustration with your portfolio not as a mistake, but as a sign of profound financial maturity. And most importantly, you have to stop chasing the comfortable, euphoric assets that everyone else is talking about at dinner parties. A truly diversified portfolio means intentionally leaving some potential returns on the table today just to ensure you aren't wiped out tomorrow.
Which leaves us with one final, absolutely crucial question to think about. Is your portfolio making you uncomfortable enough? If you are entirely thrilled with every single asset you own right now, recency bias has likely taken over, and you might be sitting on a massive blind spot. The market always demands its toll, exacting a measure of discomfort in exchange for those future returns. So embrace the unpleasantness. It probably means you're doing it right. Thanks so much for joining us for this explainer, and we will see you next time.